I hate to play this game with you, but I feel like I have to do it because you're so uptight all the time. That I'm just not going to warn you when we're just already live, which we are. So, anyway, if you guys don't know who Amar is, he's a good
Killing
friend
me,
of mine.
Jason.
I know he's a good friend of mine, and I do some consulting for his company, and I just want to have him on for a different perspective every month or so. And I did want to mention that he just got a brand new office for his company. That's why there's the most boring background on the planet there. There's a bright light behind him, which is interfering with the camera, and there's a bright light on top of him. So he'll get all of that figured out here in the future. But yeah, so I did just want to start that video making fun of my good buddy there.
There you go, Jason. There's
Yeah,
never
so
a dull moment with Jason, that's for sure.
no.
Hey, Jason, before we get started, let's throw some disclosures on the screen so
Oh,
I can keep
that's
my
right.
job.
Yeah, go right ahead. And you guys have probably heard these disclosures before, but he's going to throw them up there just so
I think
we're
you have
all
to do it, Jason.
kosher.
You're the captain of the ship here.
So we're all kosher here in terms of our disclosures. And
yeah, you don't have to read it.
Read that?
You don't have to read it. Everybody can read it themselves. But
Excellent.
Essentially, there's no client agreement that has been signed. We haven't taken your situation into context, and we're not. This is for educational purposes.
Yeah, it's not individual advice aimed at anybody. Yeah. But all right, so I do want to address the headline today of this talk. Is asset allocation dead? Now, I mentioned many times on my channel, pretty much every single live stream that I do, that although I do talk about individual stocks a lot, I talk about investment trends, and I talk about technology a lot, the vast majority of my portfolio is in really boring ETFs. I never think about it. I just add a little bit of money every month, and I won't think about it until I'm ready to retire and start taking money out. But every time we go through an economic crisis of some sort, you hear the phrase buy and hold is dead, or you hear the phrase that asset allocation is dead. But just a little bit now, let's talk about asset allocation, because this is really important. And a number of reasons why I wanted to talk about this today. I've had the privilege to have a good look at your investment models with the company that you run, and I've seen just how good your performance is comparatively when I look at the general market, or even when I look at other models that have the same risk-adjusted return, or supposed to have the same risk-adjusted return that you do. Your models are doing really, really well for your company. So talk to me a little bit about what asset allocation is, whether or not it's dead, and kind of why it doesn't work for a lot of investors.
Yeah, let's maybe talk from a high level first. So asset allocation is based off the premise of modern portfolio theory, MPT. So MPT has been used a lot in the academic world as basically creating a portfolio from a risk-free asset and an asset that takes on risk, and creating this efficient frontier. And the efficient frontier, depending on the amount of risk you want to take, there's this exact portfolio that will give us a given return based off that environment, right? So this works in academia over long periods of time. Get a risk-adjusted portfolio on the efficient portfolio. And if you've actually ever met with a financial advisor in any large financial institution, they have said that, hey, on this curve, I don't know if we can draw on this thing, Jason, but there's this curve here, and you are here on this curve, and you either can take same level of risk and get more return, or you can take less risk and get the same return. And basically, they're just moving your portfolio, rebalancing it to that one of those ideal allocations along that curve.
And how are they rebalancing and reallocating it? What types of asset classes are they using?
Yeah, so typically this is going into large, broad-based asset classes. So think large cap growth, large cap value. It's not diving into sectors, right? So these are more factor exposures. So mid cap, small cap, international, and then emerging markets on the equity side. And then on the fixed income side, they do some movement around credit in terms of credit risk. So fixed income, a big portion of that, the credit ratings is your ability to get paid back, right? And so you have these rating agencies, which we've seen in 2008, were not evaluating the credit risk appropriately, but that's a different story. Here, we're just talking about, what's the likelihood that you're going to get paid back? And you have AAA being the strongest, and then it goes down the credit stack till you get into junk bonds. So in here, you have a credit exposure, and then you have a duration exposure. So there are short-term bonds, intermediate-term bonds, and long-term bonds. In between those three, and having a combination of those, that gives you a given level of risk that can be put on this efficient market hypothesis to find where you should be on that curve. And it doesn't really talk about currencies. It doesn't really talk about commodities. And I think as we have seen, and I think so maybe we transition to why we think modern portfolio theory doesn't work for retirement planning and for the average consumer out there. There's two things in that when they were doing this analysis, and anybody does probability analysis, you've always seen this bell-shaped curve, right? And they assume the average return is here, and they're saying most of the probability returns are around that. The reality is that's wrong, right? Like if you look at any asset class, there's a long tail, and then there's a cluster of returns, but the average is disproportionately away from the cluster of returns, right? Because there is a lot of tail risk in these investments, especially with tech stuff, which Jason, I know you're really into. So
yeah, and everybody watching my channel has gotten crushed this year in tech. So there's a lot of tail risk when it comes to tech investing.
Yeah, and surprisingly, I mean, we've reduced our exposure to tech as much as possible, but tech is everywhere, right? It's hard to get around tech, and truth be told, if you look at the balance sheets of all these companies, tech is the one that still has a lot more cash on hand. So even if you're invested in, give you an example, an ETF qual, right, which is quality companies based off of earnings and cash on hand, I would say besides Costco, Procter and Gamble, the top 10 are mainly tech companies, right? So it's hard to not be exposure, not to have exposure to tech. But so going back to this, so there's no even distributions of returns, even from a probability standpoint, right? So that's the first thing. The second thing is you have to believe the markets are efficient for this to play out. Now, I think of this as, imagine if you're walking on a trail, and I'm looking out my window because there's a lot of trails out there. So if you're walking on a trail, and let's say you're walking a dog on a trail, right? Efficient market hypothesis is like the individual walking through that trail. It's smooth. It's going through the trail and making the turns, going through getting to the final destination. Whereas your little puppy on that leash, it's going from, it's darting to the left, to the right, all over the place. And that's really what's happening within the markets, right? And if you think about it, if the markets were efficient, everybody would be in ETFs, right?
Right.
And if the markets were not efficient, right, then everybody, and if, let's just say we say the markets are efficient, so everybody's in ETFs, then you're going to get mispricing, and then you'll get more, the pendulum swings into active management, and because there's a mispricing based off these large ETFs. And if we look at the past 10, 20 years, the flow of assets into passive ETF strategies creates more of a mispricing than one would think. And that doesn't come to light until you have this exposure of these downward swings where you have momentum. The other thing I should probably mention in here is the markets are not efficient because there's options contracts make up more of the overall market than they have in the past, right? So if we look 3 or 5 years back, I think it represented, and don't quote me on this, I'm just giving numbers here, maybe 10 to 20% of the notional value of the market, right? Whereas now, I think it represents over 100% of the notional value of the market. And I think it's for two main reasons. You have large institutions hedging with derivative-based products. And then you have another sector that has come out through apps like Robinhood, fractional shares through Schwab or wherever, where, on the back end of that, to have a fractional share, there is some options being created to create that those positions. And
you think this contributes to inefficiency in the market?
Absolutely. Right. I mean, think about it. If you're on an app and you can buy and sell trades, I mean, there's more emotions that go into that than actual analysis, right? So let's start with that and maybe dig deeper into the options market. The options market is not like, hey, I'm selling something and Jason wants to buy it, right? In the options market, you're dealing with a middleman, and that middleman's a dealer, right? So for every options contract, the dealer is taking a position of equal but opposite side. But the dealer is not in the business of making those bets, right? They just want to make that margin, that the options contract, that there's a fee for that. They're just making that fee, right? And so at the end of the day, they're trying to look at their net exposure and then offset that net exposure by going into the market with whatever they're doing, right? And so that produce big shifts in the markets around options, expiration contracts, and stuff like that. That also leads into the news cycle. The news cycle, and when I say news cycle, I'm talking about CNBC, Fox Business News, Bloomberg News, whatever your flavor is. They are trying to sell the viewership or keep eyeballs on their platform, and they're talking about some of these things as it impacts kind of their take on certain asset classes, right? So I would say that's the second part, is that the markets in the short term have significant inefficiencies. In the longer term, yeah, maybe they could be efficient, but the human element, which is the third part, which Jason and I, through our work experience, have had a large exposure to the human element, right? And the human element could be cash flow related, could be life experiences, could be like a health issue that comes up, and then you realize that, like, hey, this is the time where I want to spend money and enjoy my life, because we have this realization that life is finite and not, forever. So everybody has a different situation.
Right. You're saying that people aren't necessarily keeping their money in their portfolios for reasons that don't have anything to do with the market. It's the human element throws things off. It could be emotional, could be health, could be employment related, cash flow related, but they're not buying and selling based on getting the best execution price. A lot of times they're doing it based on what's happening in their life.
Yeah, I mean, sometimes people have tax bills. Some people have other things that are coming up, lifestyle related issues, and maybe they haven't kept enough cash on hand to have that liquidity covered, and so then they're looking at their portfolio just like a mutual fund manager would be. What are the things that I can sell?
Right.
Right.
That's interesting. The second part of that, we're talking about market efficiency, is really interesting. I mean, you and I both remember from around the 2005, 2006 timeframe, that the kind of media scrum in that time period was that value investing was dead because the market was so efficient. Now all information is instantly publicly available, but you're saying that some of this sort of passive investing, ETF investing, is probably going to, and that's not an argument that I haven't heard before too, that some of it is going to lead to market inefficiencies because people aren't buying and selling anymore. They're just sitting on those ETFs.
Yeah.
So,
and you can also think that, like, when we look at corporate governance, right, which is a whole different topic, but when we look at corporate governance, like if an ETF is your largest shareholder in a company, right, how are they going to vote on the board of certain things to do or not do?
Right.
I mean, like, I think BlackRock has done this analysis and has come up with kind of a game plan around that. But one of their initiatives is, clean energy, like all these other issues that are not investment direct, but just maybe, I don't know, maybe we can call it just like social issues that they've taken a stance on, right? And then they've kind of set criteria of how they would kind of govern in that. So, I mean, with those three, obviously there are inefficiencies in the markets. And I think the last thing that I would highlight is that we've seen correlations between stocks and bonds go up, meaning as stock prices are going up, bonds are going up, stock prices are going down, bond prices are going down. And in this type of environment, that can really destroy somebody's portfolio if they're based off of asset allocation model. And I think the easiest way to give that example is that if you're a conservative investor, so think of the opposite of most people on this channel, but think of people that are in their 70s and or 80s, and they're like, hey, I want to just save as much principal as possible and have a little bit of inflation protection. If they're going to their advisor at one of these companies that uses modern portfolio theory, they'll probably have 80% in bonds and 20% in equities. That is what a traditional conservative portfolio looks like. In that bonds, if you have 80%, you may have 5 to 10% in short term, and most of it's investment grade bonds. Some may be junk bonds, and then some may be long duration bonds. And right now, those investors are hurting probably a lot more than most equity investors, being that they're allocated to long duration and higher risk bonds in a raising interest rate environment.
Right. They're getting crushed right now.
Yeah.
Yeah. They're already coming off the worst year, I think, in a maybe forever, but it's at least a very long time. And next year doesn't look much better for the bond market. Yeah.
One of the statistics that I heard is that we've had the worst bond market since 1782. So like this is the second worst bond market since we've been tracking bonds and their relative performance to equities.
Like literally since the Crimean War, the original Crimean War, or something like that. So, yeah, Charge of the Light Brigade time.
Yeah. So, I think one of the questions that people will probably start having is that, all right, if you believe asset allocation is dead, what is another way to invest? How do we move? How do you invest for retirement and long-term savings without trying to find stocks and kind of bet the barn on few stocks? And I think the process is using like a risk-adjusted model that's based off of the rate of change of economic data. And kind of some of the stuff that we work on is looking at growth versus inflation. And this is kind of like Ray Dalio stuff. It's we follow Hedgeye, which is another company, and that's where we have subscription to where we get the data. But here, what you're looking for is rate of change, and then creating a framework of with growth increasing and inflation increasing or decreasing, or currently where we have growth decreasing and inflation decreasing, and back testing what asset classes work well in that scenario, right? And then kind of positioning assets in that allocation. And now we have more tools than we have had in the past, right? You can use stop losses, you can use sector allocations, and you can even just aggregately say that I'm not going to have more than a 6% position in any certain given sector, right? You can have a minimum position, a mid, and a max position in one sector, and you can throttle that up and down depending on how much risk is in the environment.
Excellent. So, and the reason that I wanted to talk about this today is, like I said, taking a look at the client first cap portfolios that were out there. I was actually kind of stunned looking at it compared to, the S&P 500. Okay, that's not a fair comparison to everything, but like looking at it, as from a moderately conservative, index, or the moderately aggressive index or aggressive index, you guys are outperforming all of those at this point, based on your asset allocation approach, which is a little bit different than what modern portfolio theory is. So
hindsight's 2020, and we can't guarantee past performance for future results. But it is so important in this environment where you have decreasing growth and decreasing inflation is to protect your principal, right? I
Right.
mean, I think that should be number one goal for most portfolio managers. We happen to have done a good job. We hope to continue to do a good job. But I think one book that has really framed my reference in all this is The Misbehavior of Markets by Bernard Mandelbrot. So
Okay.
I don't know, Jason, if you can post an Amazon link or whatever.
I can actually, yeah. It's The
Uh,
Misbehavior of Markets.
yeah, I would say that's a good book to start. If you're thinking about this for yourself, like how do I kind of implement this in my own portfolio? I would start there.
Okay.
Now,
Excellent.
one thing as a shameless plug here, Jason, like one of the things I can say is that we do a newsletter, which you can find on our website, which is clientfirstcap.com. Under articles and resources, you can find a link to subscribe to our newsletter.
I actually put the link in the description to this video.
Thank you.
So yeah, so it's already in there. And don't feel bad about shamelessly plugging your company here. I brought you on so you could talk about that. And I have the utmost confidence in you. And let's be honest here, or let's be completely open here, folks. I don't get a commission for anyone who decides to use Amar as their advisor or anything like that. There's no money.
Yeah, we have no
exchanged,
financial. So. Yeah, we have no financial interest.
No, yeah.
Other.
Although you do owe me a couple of beers over a bet, but I forget what that was. So yeah.
So let's just maybe we can pivot to ask if anybody's watching if they have questions. So I see one here: is AI being used very much to determine asset allocation strategies? I think it is. I mean, we've seen this uptick in robo advisors and robo advisor platforms using AI to kind of what I would say is tax loss harvesting and rebalancing. The one thing I would say is that rebalancing for most people that are in IRAs and Roth IRAs is almost a no-brainer. But if you're in a taxable account, then you have two tax burdens that you have to deal with, right? So you can have short-term or long-term capital gains, and that can eat away at your portfolio. So I would suggest that one of the things that we look at is to rebalance based off of tolerance bands. So once let's say if you're trying to take a let's say 10% position in one ETF, and if that grows by 5%, then you can know when to trim it back down to your target, right? Or if that is making some losses, then you know when to put in a stop loss and use that to kind of risk manage. But Jason, you have any other questions there?
No, I think that is it for right now. I'm going to continue the live stream here. And get to some other questions, but I know that you only wanted to be on for about a half an hour or so. But willing to have you on anytime you want, but we are going to do this about once a month to talk about some more advanced financial planning issues that you guys might be interested in as well. Stuff that's beyond just the very broad topics that I talk about or the individual stocks. So anyway, thank you very much for coming on today. I'm going to go ahead and continue. And we're going to talk about Tesla. We're going to talk about fintechs. We're going to talk about a bunch of stuff out there. All right.
There you go.
Okay. Thank you so much. Bye.
Bye.
All right, guys. That was my good buddy, Amar Shar. And he is learning how to do the whole live stream thing. He hasn't quite figured it out yet. In fact, there was a big, he's always very nervous right before we do these. He's like, what are we going to talk about? And I'm always like, man, let's just wing it. Let's let the people determine what it is that we talk about. And what you guys want to talk about in a lot of ways is kind of predictable to me. Like the very first thing we see on here is, hey, Jason, what happened with Cheniere LNG earnings? So their earnings came out a couple of days ago, and I did take a look at those. There was a huge earnings surprise there. It was about 43% over expectations, although it just hadn't been updated since since last quarter, and since the pipeline in Europe was blown up or sabotaged in some way. but they had a huge earnings surprise. They're investing. They did this while prepaying rather $1.3 billion in debt over the quarter as well, while they've broken ground on a new facility in Corpus Christi, Texas, and while they're expanding a facility in basically on the Sabine River in Texas at the port there. I don't know what you guys know about the liquid natural gas industry, the oil industry in general, but there are a lot of port cities in Texas that are capable of handling business out there. We're talking about Sabine Pass, Matagorda, Puerto Lavaca, in like Freeport, Corpus Christi, Brownsville, a number of other places that I'm probably missing. Oh, Port of Houston. People don't realize that's not on the coast, but it is. There's a canal that that goes from the coast. It bypasses Galveston, which is also a port as well. So when they're building those liquid natural gas stations there, a lot of that is because natural gas in Texas is basically hit close to zero. Storage facilities are full there. The markets, like we talked about before, in natural gas are more highly localized than they are for crude. And there's a liquefaction station being created in Sabine Pass right now that's going to be taking some of that $0 natural gas stocks, probably going to sell them over in Europe for very large profits. The predictions last year for LNG as a company were not very exciting. I think that the future looks pretty good for this company, but I wouldn't say that you should get accustomed to earning surprises that high. Let's not get accustomed to that. I think that was probably a one-off. So, so we see here, Tell 666999 says, "Wow, Tesla below $200." Yeah, I'm almost sickened by that. So it's not a secret that I have a lot of Tesla stock. So I've actually gotten just gut punched this year by Tesla. And I blame a lot of this on the attention-seeking behavior of Mr. Musk. And I'm just kind of sick of it at this point. And I appreciate his skill as a visionary. I appreciate the fact that, we now have private space exploration and service companies because of Elon Musk. I appreciate the fact that we now have an EV industry worldwide because of Elon Musk. Really, he didn't necessarily come up with all of these ideas. Well, kind of in the case of SpaceX, he did, but he was the visionary responsible for bringing them to the forefront. So I do think that, but I think that a lot of Twitter's woes right now are being negatively reflected on Tesla. But let's also be honest here about the valuation of Tesla. Tesla doesn't produce anywhere near the amount of cars that Ford does. Ford's market cap is like $55 billion. I don't know what Tesla's is because it's dropped so much, but it's got to still be like $800 billion or $600 billion or something like that. That's a market cap that is not necessarily justified by its current vehicle production. It's justified by that 50% growth rate, and in kind of extrapolating how long they can maintain that 50% growth rate, right? So that's what you're investing in, is that future growth. I don't like the fact that every acquisition that Elon Musk is making now seems to be taking focus away from where at least I initially invested in him, not just in Tesla, but in him. And I've been a long-time investor with Tesla. So I would like to think that there's a plan behind the Twitter acquisition. It's not a secret that he tried to get out of it. Basically, it was a really poor joke about weed that got out of control, and now he spent $44 billion on this company. And so I'm very interested to see what happens. I'm interested to see how he monetizes this business. Twitter has never really been a very profitable business. I think they only profited in 2018 and 2019 and have been unprofitable ever since. The fact that they've lost a bunch of advertisers, or at least a lot of advertisers have started to say that they're pausing advertising, is a concern. The other thing that's a concern is the checkmark thing is not going to work, man. You need to sell like a minimum of 10 million verified accounts in order to, for $8 a month, in order to pay all the bills for Twitter. So that's a concern too. At some point, advertising has to be, or some other stream of income has to be your main thing. So yeah. So happy to answer any questions, guys. I'm going to talk about a few things here. And let me see here. And So yeah, so tell 666-999. I'm trying to show your your comment here. It says, why would he advocate voting for the GOP when as a party they don't support climate change or EV adoption? So I think that like I said, it's the attention-seeking behavior that has really gotten on my nerves. And he was mostly non-political for years and years and years. And I think because a few prominent Democrats were critical of him, he has suddenly had this very childish reaction, and has started to get involved in politics, not realizing that. Well, here's the other thing. It could be kind of like a double envelopment strategy here. He knows that the GOP didn't support his ideas about climate change or EV adoption. He also probably knew that they were the biggest roadblock to his plans out there. So maybe this is a rope-a-dope. I don't know. But maybe if they can get them, he can get them to like him, they're going to support more of his ideas. So I don't know, but I don't tend to delve too deeply into politics on my channel. I certainly have opinions. I just don't think that they're very useful. And if you take a look at my screen here, where it says why a split Congress might not be good for stocks at this time, you can research on your own which party is best for the stock market, which party has better performance in terms of GDP growth, private sector employment, income growth, stock market growth, that sort of thing, and come to your own conclusions. But as I've stated several times on this channel, who wins an election or who wins a midterm election has very little effect on the market beyond a couple of days worth of buying and selling. Meaning some of what's going on today right now is probably in anticipation of Republicans regaining control of the House, which if you do your own research about which party is best for the stock market or the economy, you might end up changing your mind on that. But also beyond the next 2 or 3 days after the election on Tuesday, it will make no difference whatsoever. So, and that's always the case. Research on that goes back for a very, very long time. So, and Chula Joe says, hey, Jason, have you researched D. Chobe a lot? Just wondering how you thought the Moneyline CEO compared to Noto or Musk. I haven't researched him that heavily. And probably it's because I mean, although I own a butt ton of shares, I don't have a ton of money sunk into it. It's more of a speculative risk for me. I think I still spent under $20,000 on Moneyline shares. And I just have a ton of Moneyline shares at this point. And this is a strategy that I've used a couple of other times, meaning that when we're in the bottom of a market cycle or pretty close to it and the economy looks pretty bad, taking a company that has pretty good growth, is growing during this downturn in the cycle, they have cash on hand, and they have a fairly good business strategy has worked out really well for me. I think the biggest risk that I took recently in the last like 5 years or so that there was no real justification for it. That was Neo. There wasn't, when I took my big risk in Neo, there was no justification for it. But once again, I didn't have that many shares. It wasn't that much money that I put into it. It just tended to work out really well. In terms of Moneyline, though, I would have a long-term position in this company, probably a lot smaller than I would have now if we didn't have this kind of macroeconomic headwinds working against it. So, yeah. So Tesla 197 going to 180. Then again, do I care if I believe in the company? Excuse me. As usual, I sneeze on cue during my live streams, and I don't sneeze the rest of the day. Yeah, so I'm actually thinking about selling some puts at about 180, and I think that would probably be the next stop in terms of the bottom for Tesla. And I'm probably going to sell some puts on that, hoping to generate a little bit of income in the meantime. I still have a lot of conviction in Tesla's long-term vision, a lot of conviction in their ability to grow sales. China is by far the largest car market in the world right now, single car market in the world. It's certainly not the only one. And I am looking forward to Tesla aggressively developing other markets. I think they haven't taken a hard enough run at Europe at this point. I really do. I think that their sales network is their service network actually could stand to be improved there. And I think that there's markets in other countries that they just haven't gone after as well. So Elon does have a plan behind the acquisition of Twitter with Jack Dorsey. The plan is a digital payment system. Okay. So no, I understand that that's not necessarily one that I'm excited about. What I'm more excited about when it comes to Twitter is the vast reservoir of data and that's really what Twitter's only has two ways to make money, and that's advertising and by selling your data. Elon Musk may not necessarily be after selling the data. He may be after using the data in a lot of different ways. So it is one of the largest repositories of data on human decision-making on the entire planet. I don't believe that the plan is a digital payment system. I really don't. I think that it has something to do with the data. And that may have been the original reason. And I was actually convinced of this by someone that I had a Zoom meeting with who works for a really large software company. And he basically sent me a quick email saying, this is probably what it's about. And the more I started thinking about it and researching, I realized that it is probably the largest repository of user data of that type. My issue with Twitter, though, is how skewed that user data is going to be because of how narrow a slice of the population is actually active users of Twitter, meaning they actually post themselves and respond beyond like liking certain things, so or retweeting. So that's kind of my big worry about that. My other worry, like I said, is that he's got to come up with a way to monetize his business relatively quickly. And he's got to, and when I say relatively quickly, within a year, I think that the wheels are going to start coming off Twitter if he doesn't define a pathway quickly. And like I said, it's a privately owned company right now. He doesn't have shareholders or a board to answer to, but the wheels could come off the bus there pretty quickly if he's not able to retain top talent in the industry. So that's what I'm really worried about that. So, political party so ill to find now. History isn't too much of a predictor related to that. Yeah, I just don't have a comment on that. So, see, Dewey says, as a Canadian, I'm watching the U.S. political process with interest. When the U.S. sneezes, Canada gets pneumonia. There's a giant difference between the Canadian population and the U.S. population. The Canadian population is simply far better educated than the U.S. population is, and that's a statement of fact. It's not one that can be easily disputed. In terms of literacy rates, in terms of high school completion, in terms of college degrees, in terms of poverty, all kinds of things, Canada's much better off than the U.S. to a lot of different degree. But I think your population is probably less susceptible to a lot of the negative things in American society is because of that. But yeah, so I'm watching the process with interest, but with interest meaning that I'm just planning my next moves, guys. So I'm planning how I'm going to invest based on economics, based on geopolitics rather than local politics. I'm not sure if you guys are paying attention to geopolitics as much as I am. I do talk about this a lot, but one of the things that I'm really paying attention to right now is sort of the global shift in markets, in production, in manufacturing, in commodity sales, and things like that. And the idea that I dismissed for such a long time of reshoring manufacturing here to the U.S., I do think that most of that is never going to be reshored to the United States. I think we're going to be diversifying our manufacturing base away from China. I think we'll be moving some of it into Southeast Asia. We'll be moving some of it into India. We'll be moving some of it into Latin America and that sort of thing. But I don't think we're going to be bringing low-end manufacturing back here to the United States. I think a lot of our higher-end manufacturing may return to the United States. It may not bring all of those jobs back with it, though, and that's kind of what you should be prepared for. And but things like battery production, because of U.S. law, and of course the Inflation Reduction Act, and of course the CHIPS Act as well, we're probably looking at some degree of semiconductor manufacturing returning to the United States. A huge investment in battery production here in the United States a huge investment in a lot of other industries. But things like steel making, probably not going to come back to the US. Things like plastics manufacturing, probably not going to come back to the US in a lot of ways. A lot of the parts of auto manufacturing are probably not coming back to the United States. I would be surprised if we didn't see a shift to Mexico for a lot of those jobs, though, and or even to Canada for a lot of those jobs. But I think final assembly and things like that's probably going to come back to the U.S. And a lot of that has to do with risk mitigation on the parts of companies out there right now. Like TSMC is opening up a giant factory in Arizona. Part of that has to do with, and they started this before the Inflation Reduction Act was written into law. I think a large part of that was just simply, risk mitigation. I think you're going to find a lot of companies out there. If you look at China right now, they pretty much lost all manufacturing for the iPhone. A lot of that has to do with recent restrictions that were put on China through the sanctions. Everyone talks about being tough on China. And first of all, I don't know what that means. I don't know what people want when they say being tough on China, but I can say one thing, that the recent chip restrictions, export controls put on China are not crippling to China, but it's going to be extremely expensive for a very long time for China. And this is the toughest thing that anyone has done to China in 50 or 60 years. This is really going to affect their economy, and they are really going to have to refocus their scientific efforts on developing some of the technologies and processes that we're now denying to them, and replacing a lot of the people that are leaving China. There's a brain drain going on right now that are people that are leaving China in the semiconductor industry. They're going back to the US, they're going to Taiwan, they're going to Holland, they're going to, I forget the name of the company in England, but a lot of them are going to either Taiwan or the United States or to Holland or to Switzerland. So that is what's going on right now in the industry, is they're losing some of their best and brightest minds who are running the processes and technologies needed to produce these higher end semiconductors. So that is, yeah. Hold on just a second here. Frantic Pillow says, I've only been hearing doom and gloom about tech stocks and the stock market in general this year. Please reassure me and tell me it's going to be okay so I continue studying. Well, it is going to be okay. And I've said this before on the channel too. Every time that I've experienced a recession, even imaginary recessions, and I've experienced several of those in my lifetimes where everyone says a recession is coming and it never does. The stock market will sometimes decline by 10 or 12% in anticipation of recession, and it doesn't come. But even when we did go through a recession, it's always sunny on the other side of it, buddy. And I would say that we're already well into a lot of the pain right now, and a lot of the moves that you'd make right now to mitigate some of that pain would just result in you missing out on the run up that's going to come at some point. So, but when it comes to tech stocks, Amar was right that a lot of these stocks that are on these quality indexes, there's a bunch of ETFs that are deemed to be made up only of quality stocks, and a lot of this has to do with growing profits and cash on hand. The companies that have the most cash on hand right now are the larger tech stocks. They are well set up to weather a lot of storms. The dangers that we're looking at are some of the companies that were some of the small cap companies I was covering last year and the year before that, where I was really neutral when I covered those. What was it? Vizio was one of those where I just didn't see what everyone was excited about. Nano Dimension, I didn't see what everyone was excited about. There are half a dozen other companies like that. One of them was a bunch of more than like the LiDAR industry, where I just didn't see why people were so excited about it. So I tried to stay as neutral as possible. But a couple of companies are probably in trouble, more so than they've ever been. And, one of those is going to be, I think, Plug Power. And it was a darling last year and the year before that. Plug Power is a company that's been publicly traded for more than 20 years and has never made a profit. They've been running on empty promises for 20 years. their management is dominated by people from kind of the old world. And I just don't think they have the dynamism to make it past this sort of capital crunch that we're going through right now. So that's one of the companies that I don't think will make it out there. But there's tons of quality companies that are. I would be a little bit more willing. In fact, it's not that I would be. I am a lot more willing to invest in more boring companies right now. So yeah. Let me see here. Reshoring of low manufacturing in Mexico and low chips to Colombia. So you're probably going to see higher end because chips have been manufactured in Mexico for quite some time now. And I think you're going to see absolutely a reshoring of some of that manufacturing back to Mexico. And I think it's going to be a little bit higher up the value chain there because they've got a 20, 30-year tradition now of manufacturing. So I had a friend years ago, growing up in rural Texas, you are friends with people who are mildly racist. And he just claimed that it was never going to be possible to build chips in Mexico because they had issues with cleanliness. And I remember telling him that this was the most ridiculous idea I'd ever heard of. And this is, not before the internet, but before the internet was covering everything. And I didn't know that there were already semiconductor manufacturing going on there. But it's actually been going on there for about 30 years now. And if you look at, and here's the issue with northern Mexico, the places closest, there's only about 30 million people that live in northern Mexico, and a lot of them live in central Mexico, and that's kind of where the bulk of their educated population is as well. We think of the United States, we think of the northern areas of Mexico being the most important economically, which to a degree they are, but just because of imports and exports. But in terms of like the population and the access to the educated people we want to run those facilities, that's going to be like closer to the Mexico City area and their larger population centers. And I wouldn't be surprised if we see announcements that something is going on there, and possibly to Colombia. I don't. That's the one I'm not really sure of. I would actually, and if it weren't for, there are a few reasons why I think that Costa Rica would probably be the best option, and a lot of that has to do with the political stability there. And Colombia is much better, and I was just there recently. It's much better than it has been in the last 30 years. Of course, it's an amazing place to visit. It's a heck of a lot safer than it was, and it's very tourist friendly now. But in terms of, and maybe I'm just looking at things a little bit differently when I travel, but I saw way too much inequality there and way too many barriers in place for regular people to succeed there. That did get me a little bit depressed about Colombia, despite the fact that I really enjoyed my visit there. I met tons of great people, and I spoke Spanish the whole time I was there. Costa Rica, on the other hand, though, has tremendous political stability. They don't have a standing military. They have a relatively honest police force, unlike the rest of that region. Relatively honest guys. Never had to pay a bribe there. No one's ever asked for one, but it's one of the only places. Or even Chile would actually probably be a great bet for that as well. So yeah, let me see here. Canada just forced China out of Canadian lithium mining. Ballsy move. So that is something that I had not heard of. That is absolutely something that I'd not heard of. I'm going to go research that when this is done. So I recently watched an interview with Professor Steve Henke, who says basically the U.S. next year has a high chance of being in stagflation. So I think it was in March, someone said, hey, we have low economic growth and inflation. We're already in stagflation. So stagflation is generally defined as a much longer time frame than just a year or so. You're looking at like 1973 to 1982. That would be the period we called stagflation, where we had economic growth just barely outpacing inflation. And right now, that's definitely the case, where economic growth is barely outpacing inflation. And the 2 quarters prior to that, it was actually shrinking. So the plan for the Fed, and they're not making a secret out of this, guys. The only question is, where do we stop? Okay. So ostensibly, if you wanted to stop inflation in its tracks right now, you'd raise interest rates to like 10.2%. You'd crash the economy. You'd have another 4 or 5 million people that are unemployed, destroying 4 or 5 million jobs or so. You keep it there at 9 months to a year, boom, inflation is done. Okay. So the problem is, in this case, it's probably not going to work. Inflation is not limited to just the United States. It is worldwide, although we are a huge driver of liquidity in the world. There's lots of other countries that have to deal with this time around. Like there's very few places where we don't have inflation. You're looking at, inflation in the double digits in Turkey, all over Eastern Europe, all over Western Europe, all over the Middle East right now, South America as well. Has very little to do with the Fed. So the Fed's tools to this degree are a little bit limited, right? But I will say that the Fed actually has far more tools than they did in 1982. The idea that you could control interest rates, or you could use interest rates to control inflation, was a brand new one when Paul Volcker decided. It was just theoretical when Paul Volcker decided to use that as a sledgehammer to drive the nail into inflation, right? This time around, the Fed's enormous balance sheet is going to play a role. So the plan, and this is what they've indicated, and this is what they're trying to tell us, and this is what it is in the beige book. Go read the beige book, guys. The Fed puts it out. That's exactly what they're going to do. They're going to raise interest rates up somewhere north of 4.5%. The stopping point, it hasn't really been defined yet, but at this point, I think it's north of 5%. And they're going to leave them there for a while, for a long while. Even if there is still inflation, but when they see inflation start to fall, they're going to leave interest rates where they are, or slow down to like 0.25% per quarter. And so I'm gonna get to that, Bram. That's a great comment. But they would slow it down like 0.25 point per quarter. But then they're going to use the power of what's on the balance sheet. They're going to sell the bonds that they have on the balance sheet, which is going to crash the price of bonds, which is going to raise yields due to market forces, not by the Fed raising rates. It's market forces are going to keep long-term yields high. It's going to reduce the prices of long-term bonds. It's going to allow the Fed to get a couple $1 trillion hopefully off their balance sheet, while at the same time achieving that goal. And when they want things to change, they simply stop selling those securities. And there's immediately going to be this valve taken off of the economy, and it gives them more room to cut interest rates in the future. And I do think that they're setting themselves up for a normalization of the Fed's role in the economy. It's been really out of whack. You could say it's been out of whack since 2008, but the reality is it's really been kind of out of whack since 2000. So 2000, 2001, 2002. We had, 9/11 happen, but really we had the end of a credit cycle before 9/11. So in 2000, the market was down 9, 2001, it was down 11. And then 2002 it was down, I think 22. And that was really the end of a market cycle, the dot-com crash, but that was the end of a credit cycle rather, with the dot-com crash, where people in ever search of yield, that took more and more and more risk, and credit got out of control, and then it contracted. I think that the stimulus was successful in that case, that the government did, but I think it was actually unnecessary to a large degree. I think it was unnecessary, but it set the stage for later interventions. And I think the Fed learned a lot from 2008, where they did too little, and that's the reason that that recession lasted as long as it did, and that's the reason why the recovery was rather anemic. But there's not a reason to complain about GDP growth at 2%. GDP growth at 3% is fantastic. GDP growth at 4% is probably overheated, but there isn't a reason to complain about GDP growth at 2%. But politicians kept complaining about it. And that's one of the things that kind of mystified me. Is around about 2010 or so, January of 2010, the economy grew pretty much right around an average of 2% from that point on till roughly 2017, where suddenly it spiked up to like 4.4% or something like that, where that's already an indication that relatively rapidly the economy is going to be overheated. And I think that we should have actually gone into a recession at the natural end of the credit cycle, probably sometime around 2018, when we had a crisis in short-term bonds and the Fed intervened in that. And that's something that's not been well covered. I want to have my buddy Tim Kenny on here to talk about that at some point. But that's actually really an interesting story that never got any press. The Fed stepped in and basically had to rescue the short-term bond market in 2018, and no one noticed. So Bram makes a poignant comment here. A 10% rise in interest would benefit the pitchfork manufacturing sector. Oh, you poor Canadian. You poor Canadian. We don't need pitchforks in America. We've got guns. Well, ballot boxes too. But no, I understand what you're saying. But think about what happened think about what people believe normal interest rates to buy a home is, right? I'm talking to young people right now. When I say young people under 35 who don't even believe me when I tell them that my first home I bought at, I think it was a 9.5 or 9.75 interest rate. And that was a good rate at the time, a good rate for a first time home buyer at the time. So, yeah. What's your view on commodities? Something I have no real knowledge about, such as, it's a wide field to encompass. The vast majority of what goes on in the commodities market is really for professionals, right? Meaning that these are people that are actually delivering commodities to market, and they buy futures contracts to guarantee a price or to guarantee delivery of the commodity. And this doesn't happen anymore, but back in the day, you used to hear these horror stories of people having 100,000 cases of canned pork delivered to their house because they couldn't dump it fast enough, right? These stories are like 40 years old. That doesn't necessarily happen anymore. But the vast majority of the business that goes on in the commodities market is about someone trying to guarantee a price at the time of delivery. And I think that your best bet for betting on a wide boom in commodities, because and we still haven't seen the crash in commodities that I expected out of this. But I think that's coming at some point. Your best bet is to buy an ETF or a commodities mutual fund. And if you believe, like Amar does, that the market is becoming more inefficient because of modernization, or you believe that like I do, the market is more efficient because of modernization, I think that you probably want to check out an ETF or a mutual fund for commodities. Do not, meaning you could do a wheat ETF or an oil ETF or a gold ETF or something like that. But I wouldn't go out and buy your own futures contracts on that. So yes. Hi, Jason. To what effect do you believe the CPI report on Thursday may affect the market this time around? The market is steady despite the last meeting due to wholesale lower rate rise and what. So I think CPI is still going to be bad, and largely because a large component of that is rent, and rents are not declining fast enough. And if rents don't decline faster, the rest of CPI could drop to zero, and it's still going to be such a large component that it's not going to have a big enough effect on CPI to make it look good. So I think that CPI still stands at around 8.1, 8.2% inflation. If it breaks 8%, below 8%, I think that's fantastic. I think that's utterly fantastic. I don't think it has a ton of effect on the market, not until the Fed says, hey, 1 month of data isn't a trend. We want to see a trend. Once they start to see those trends, I think that that's the point where they decide to dial back the interest rate rises. I wouldn't be surprised if we only saw 50 basis points at the next meeting. But I think that if CPI doesn't improve, they'll keep it at 50 basis points for another couple meetings, right? At least that's my opinion. So, yeah. I was looking at CMOD, covers all but possibly too all-encompassing that the gains may offset the loss. There is such a thing as over-diversification. There really is. But at the bottom of an economic cycle, CMOD would probably be a pretty good bet. And correct me if I'm wrong. This is one that covers pretty much the commodities index, right? I'm not familiar with that particular fund. So let's see what that is. At the bottom of an economic cycle, which we may or may not have reached it at that point, based on commodities prices, it would not appear that we have reached that. There are a number of commodities that are still really sky high. But one of the things I'd be looking at right now, because building has really started to slow down, is copper. Yeah, it's a commodities index. You see here. As usual, my internet connection is so slow here that a single web page, if I'm on a live stream, takes forever to show up there. So year-to-date return on this is already 15%, though. Let me see here. 1 year. This is a relatively new fund, too. So this is an Invesco fund, which means it definitely comes from like a real company. They're a huge company out there. They absorbed a number of the companies that I used to work with in the past. Expense ratio is fairly low. Yield on this is, of course, going to be zero. It's not going to pay a dividend, and it's a commodity index fund, like I said. Volume on it's like really low. It's only 22,000 shares change hand today, and average volume is about 50,000 shares. I would want to. I think I'd want to look at something else besides this. Right, there got to be a number of other commodities funds that have a bit more in the way of liquidity and a bit more, like I said, in the way of average volume in there. So I would be happy, or I would not be looking at this because of its low volume. So yeah, ignore the pink Winnie the Pooh coffee cup, guys. I'm just kidding. Don't care. I'm one of those guys that drinks coffee all day long until like my stomach starts to hurt. And today I actually made like a second pot. Don't tell my wife that. But yeah. All right, guys. Any other questions? We're coming up on an hour. I generally try to keep this under an hour so I don't wear out my voice. And not that I have to do a ton of other talking during the day. But yeah, so I'm glad that you guys watched Amar. I always want to show his perspective. He and I do tend to have a lot of disagreements on, and good friends should have lots of disagreements on philosophies and things like that. And when it comes to investing, and he's someone that I really do pay attention to a lot. He always points out something that I wasn't considering, right, at all times. And everyone should have a friend like that. Oh, one thing I did want to cover tonight, and this is not investment advice, definitely not investment advice. The $1.9 billion Powerball jackpot. So I went out this morning and paid my stupid tax. My tax on people who can't do math, meaning I went out and bought a couple of lottery tickets. So the jackpot is $1.9 billion. So if you take the lump sum, how much are you getting? All right. So I'm going to so basically a 24% withholding right off the bat, which is, you're going to be in the 37% tax bracket plus whatever state you're in. So that's not enough, right? So don't run out and spend the whole, $900 million after that, right? That you have left, but 24%. So your annuity, if you choose the cash option over the annuity, which in most cases, if you win the lottery, the jackpot you'd be better off choosing the jackpot. In most cases, if you're extremely young, maybe not. And we can talk about that too. If you're extremely young and you're disciplined and you have an investment strategy and you have someone to leave the money to, then that annuity option might be better for you. But most of the cases, I'd say 80% of the cases, the cash option is going to be better. It would be $929 million lump sum. That is the present day value of that $1.9 billion over a 26-year lifetime at whatever the given rate of interest is that they're defining for that. You can probably do better than that in the stock market. The problem is you have to pay taxes on that all at once. But whether or not you get the annuity or you get the cash option, you're still in the top tax bracket. So it's not going to save you any taxes by choosing the cash option over the annuity, right? So let's just throw that calculation out the window. So on the $929 million, you're going to pay $223 million in tax right off the bat. Okay. So that doesn't tell you the whole story. That's just going to be what's withheld. So the top federal tax bracket is 37%. And applies to all income over $539,000 for an individual or $647,000 for married couples. So, if you live in California, you also, or in a lot of other states, you also have to pay, you have to pay taxes on top of that as well. So they're going to be state taxes due, but you're probably looking at an estimated additional $343.8 million going to federal coffers. So I'm sorry, a total of $343 million. So you'd walk away with $585.3 million of that $1.9 billion grand prize. There's somebody out there right now when I describe saying, oh, you won $1.9 billion, but because of the lump sum option and taxes, you only walk away with $585 million. There's somebody out there who's really pissed off with me saying that. Man, I would be really, really happy with that $585 million. And every time someone contacted me to ask for money, I'd be like, yep, sorry, all $585.3 million have been spoken for. I have plans for them. And boy, do I have plans. I do have some charitable projects that would cost tens of millions of dollars that would have no economic return to me personally, that I would definitely spend the money on, absolutely spend the money on. So, and there are a couple of different neighborhoods here that there are a lot of talented people that I know in those neighborhoods. There just isn't a lot of money for them to get their start in life. They don't have the right educational opportunities. One of the things I would do is build a childcare center there. So, a free childcare center in that neighborhood. So, single moms would be able to. How many boats would I buy? That's a great question. That is a great question. Beyond my charitable ambitions, there would be a few boats. There wouldn't be like $100 million super yacht or anything like that, but there would definitely be a few boats. Not only that, I'd probably spend the rest of my days making YouTube videos and just building boats. That's the other thing I would probably do out of the best materials. But the with that $585 million, the one thing I would not do is set up my children to be wealthy for life. I would set up a trust for them, one that would have a payout at 25, a modest payout at 25, when I assume that they finished their undergraduate and university, they've gotten their start in life, a modest payout, which would be enough for, more than a down payment on a house, but not paying for the whole thing. And then at age 35, I give them a more substantial payout, but not enough to make them wealthy. Because I think that that wealth to a degree is a killer of ambitions when it comes to young people. And I am glad that I never had the money to do what I wanted when I was younger, because it made me be disciplined enough to get to where I am today. So that is one of the other things I would do, is make sure that my kids didn't think that the money was theirs and didn't think that they were going to be rich. And I would let them know that almost all of it was going to charity, and almost all of it was going to fund projects to better humanity. So let me see. Tesla, why the fall today? Was it? Oh, by the way, Vane, thank you so much for the super sticker. You consistently donate to me. As far as man, I've had a lot of cups of coffee on you, man. Thank you so much. Tesla, why the fall today? Is a political speech he gave urging to vote Republicans. Was it Twitter related? I think that it's mostly just related to the fact that people realize he's distracted by Twitter. He's got the Boring Company, he's got Neuralink, he's got SpaceX, he's got Tesla, and he's got Twitter. And I think it's the constant attention-seeking behavior. So there's been a couple of other notable billionaires who've gone off the deep end, like John McAfee went off the deep end, like Howard Hughes went off the deep end, and it looks like to a degree Jeff Bezos is starting to go that way as well. But eventually these guys, when you have enough money and you have enough power, nothing satisfies these guys, or nothing can keep them engaged or anything. I really wish he would just concentrate on Tesla. And Twitter represents one more distraction from the core business of growing Tesla and electrifying our economy and moving us away from a carbon-based economy. So I don't really believe his free speech argument. And I think the free speech argument is flawed to a degree. I'm a free speech absolutist too, but what was going on with Twitter is very much in line with capitalism, meaning that it was really pressure from advertisers who don't want to be associated with certain types of speech, who spend money on that platform, that pressured Twitter for content moderation. Now, he can change the content moderation all he wants, but if it becomes a haven for neo-Nazis and other really regrettable human beings, then advertisers will still not want to advertise on that channel. So how is Twitter, or on that app, so how is Twitter going to make money without advertising? Right now, he can sell your data as a Twitter user. That's one thing he can do, or he can sell the check mark. And I've already stated that he'd need to sell about 10 million $8 check marks just to make up the $1 billion or so he's lost already, just after taking after the company in terms of advertising. That's what he have to do. Plus, the only other option there is selling that user data or monetizing that user data in a different way. And I think that's probably the path that he's going to take with Twitter, is using all of that user data with Twitter and figuring out a way to monetize it that doesn't have as much to do with advertising. So, and he promises that it isn't going to become a cesspool of hate speech. But I don't know. I think he's going to fall into a really dangerous trap. You think you can do better than what Twitter was doing before? I'm not sure that you really can, and be fair about it. It's not possible to have human beings moderate all content. Some of it has to be programmed by AI. a program. And so artificial intelligence is doing it. It's not doing a great job of it. Is there a way to improve it? Are you going to piss some people off? Like, I don't think he does a better job than Jack Dorsey did. I really don't in this respect. What he may do a much better job of is monetizing that business. And that's what I'm interested in seeing, is whether or not he can monetize Twitter. All of this, though, takes focus away from Tesla. So Tesla just had record earnings. There are a few worrying signs about demand in China. 1 month doesn't make a trend, though. And if you look at all Chinese car manufacturers, it's not just right now, but the sales tend to be a lot more volatile than they are in the U.S., with tastes going back and forth between companies all the time. And this is true of, like, if you look at pre-2020 sales of Geely or BYD or any of the other Chinese automakers out there, sales varied pretty wildly month to month in comparison to US and European markets. It's just a more volatile market there. So I'm not going to read too much into possibly declining demand in China. Also, let's remember that a lot of what's being produced in China is actually being exported right now. And I think the plan is probably to have more of that exported until, Giga Berlin is up and running at full speed and Giga Austin is up and running at full speed. We also have the Semi being, it's going into production next year. What they were saying, by the end of first quarter next year, they're taking the first deliveries in December. I think, is it Pepsi taking the first deliveries in September? So yeah. And Vein H says, "You're welcome, Jay. I'm a coffee fiend here too. Drinking as long as you speak." Yeah. So not going to be too much longer, but yeah. So that's kind of my issue with Twitter and Tesla right now. His romance with Twitter, I think, has done a real disservice to long-term Tesla investors. And stating things on Twitter like, "Yeah, I don't really care about the stock price," that's really bad for people who want to invest in Tesla. It's really bad if you want to go out there and raise money through secondary stock options. It's really bad if you want to go out there and raise money with a convertible bond to tell your potential pool of buyers that you don't care about the stock price. You should. As a CEO of the company, your job is to make sure that stock price is fairly high. So yeah. And Vein H says, "You're right, man. I think the advertising business is definite sensitive type to material posted on there. Somehow it has to be monetized. It has to be moderated and monetized. And Tesla shouldn't be affected by Twitter, but it's going to be affected by Twitter." And the other thing, I wish he would get over his spat with the SEC. Don't mess with the SEC. It's a lot like trying to fight the Fed. It's not going to work out for you in the end. So Q4 deliveries I expect to be down as people will wait for the IRA credit. I don't expect deliveries to be down. So they do. I don't expect deliveries to be down. I think people aren't going to wait a ton for the IRA credit at this point. I think that very few people actually understand what the IRA credit is. So yeah, that's one of the things is most people have never taken a look in the United States, have no idea what's in the IRA bill, no idea why it's called the IRA Act. It never should have been called the IRA Act. It's really weird. So yeah. So I think also that Q4 deliveries will probably be in line with expectations. They're going to be very, very close to that 50% growth goal for the year. I don't know if they'll be over it, but I think they're going to be very, very close to it. Maybe a little bit below it, maybe a little bit above it. At this point right now, their production has expanded so much that if they were off that 50% growth goal by some, I probably wouldn't be too surprised, and I definitely wouldn't be too upset by it. Even if Tesla was growing at 20% per year at this point, it doesn't justify the stock price that it has right now, but it would eventually justify that stock price, and I would probably still hold on to it. But in this case right now, or in this time right now, I'm still expecting roughly, for it to be in line with expectations, pretty close to that 50% growth. So yeah. And if Tesla holds the 193 low support, I'm going to buy something soon. I'm probably going to sell a put for 180. And yeah, because I'd like to make some money if it never hits 180. Yeah, and I usually do that to acquire Tesla. When I want to acquire Tesla, I'll sell a put at like some ridiculously low level. And because of how volatile it is, I hit those low levels quite a bit. Right now, though, right now might be a different story, though. I think 180 is not out of the question by like March or so. It's not out of the question by March, especially if there's unforeseen geopolitical issues. And right now, I think that unforeseen political or geopolitical issues should be seen as likely geopolitical issues here in the future. That's one of the things I'm very worried about. All right, folks, my voice has just about had it today. I'll be back for sure on Thursday. I'm going to take a look at Upstart earnings, I think in 2 days, and then Moneyline earnings on Thursday. And like I said, Moneyline for me is a speculative stock. Is it going to be $100 a share 5 years from now? I don't think so. Is it likely to hit $5 a share in the next 2 years? I think that's pretty likely. Is it likely to hit $10 a share in the next 5 years? I think that's fairly likely, which is one of the reasons I bought a butt ton of shares for very little. And they do have a slightly confusing business model. It's not one that I necessarily would have expected them to come up with, particularly when it comes to their media approach there and their servings of financial education along with their app. I think might work for a pretty large slice of the population. Let's remember, worldwide, there's something like 500 billion accounts that are up for grabs. Okay. There's a lot of room for a lot of these companies to be successful, really successful, without being serious household names. Like, there's a number of financial apps that I never use. Like, I never use Cash App. Like, I use Venmo and I use Zelle and I use SoFi, but I'm not using Moneyline's app. Like I said, I've never used Cash App. A lot of things I don't use just because, and there's no one ecosystem is going to win. The winners are going to be the ones who grab the most amount of that 500 billion accounts worldwide that are up for grabs. And like I said, there's a room for a lot of companies to be success. Yeah. So earnings are on the 10th. They're on Thursday before market. Earnings before market is usually a good sign, folks. It usually means there was an earnings beat. Earnings on a Friday afternoon after market close usually means something pretty bad. So not pretty bad, just negative news. They want people to digest over the weekend. All right, folks, my voice is basically gone. Wanted to say goodbye. I will see you guys on Thursday. And I may put out, like I said, a video on Upstart whenever their earnings come out. Thank you very much and have a nice day.